Welcome back to the Dividend Diplomats YouTube channel, guys. You've got Bert, the Hurt Man, and Lanny, your favorite dividend investors here with the Dividend Diplomats, guys. And we're talking about not one, but two dividend growth stocks to keep on that radar now that they have been crushed over the last week slash month. Really keep your eyes out, especially during this heavy earnings season. We wanted to bring you a little something something here on your Sunday morning. So get your coffee, get your beer. Time to dive into these two dividend stocks, baby. Ooh, the Bud Light, the official beer now of the UFC.
Let's see, yeah, let's see how these brownies do. Without Deshaun Watson, we have our rookie quarterback. That's a story for a different day. So while you're getting your coffee, while you're getting your beer, if you haven't already, subscribe. Give the video a thumbs up. Help your boys reach 19,000
Come on.
subscribers. Let's freaking go. Lanny, are you ready to talk about some dividend stocks today?
Guys, we're talking about two stocks. Hold on tight, giddy up. We got both of these stocks. Actually, I own both. Bert, I'm pretty darn sure you own both of these stocks as well. In fact, I know I own well over, gosh, I'm checking it out right now and giving you a nice live feed here on the portfolio. I own over 168 shares of one stock. And then in the other one, I definitely don't own as much, that's for sure. Not anywhere. Actually, no, I take it back. 176 shares of the other company. So,
All right,
um,
let's go.
solid positions here, guys. We're talking big hitters. And the question's going to be when we get into them, do you own these stocks?
Well,
Let us know when we get to them in the comments below.
there's only one way to find out, Lanny. It's we're going to talk about the companies. We're going to run them through our stock screener, which features three metrics and a bonus metric: price earnings ratio less than the S&P 500, payout ratio less than 60%, history of increasing those divvies, those mother effing divvies. Everybody, let's go. And that bonus metric is the dividend yield.
Guys, let's get into grocery stores right now. There's a big deal going on with Kroger and Albertsons, a
Oh,
$25 billion deal right now. Kroger buying Albertsons, a very long awaited deal that should be closing here soon.
mm-hmm.
And Kroger, guys, we needed to bring back Kroger because, and the ticker symbol for them is KR. If you're in the Midwest, you're probably more familiar with the stores, especially in the Buckeye State that we are in, Ohio. Last 6 months, the stock price is actually down 14%. And let me tell you this is a beloved dividend growth stock because in a very high inflationary time period, very tough time period, Kroger keeps juicing up the dividend and doesn't give a damn about what you're thinking because they increased their dividend well over 10% this year. I'm pretty sure it was 20% last year. So buying a company, not buying a
Yeah.
company, they're saying we're helping you shareholders.
That's exactly what the key piece is because they are growing, not just that dividend, but they are growing their grocery store empire with that Albertsons acquisition. So it's huge when you see the company doing that and then just saying, like, hey, you guys, we're not taking it easy. We're not taking it easy. Forget about it. We're going to increase that dividend however much we want to. Did I do it?
Hey, you
Let's
talking to
forget
me? You
about it.
talking to me? So yeah, Kroger guys,
Yeah.
KR, the trade at $42.66. We're going to quickly get to the dividend metrics to see if you think this stock is a ripe stock right now to buy with the combination of the growth rate, the yield, and the PE ratio. Looking really solid right now, guys. 42.66, earnings expected of 452, below 10 PE, 9.44.
Beautiful. Annual dividends $1.16. That payout ratio is 25.66%.
Ooh.
Beautiful.
Hmm.
Beautiful. What about that dividend growth history, Lanny? Why don't you tell us about that?
What about it? No, hey, you
Yeah.
tell. Hey, you
Yeah,
tell.
you want me to tell him? You want me to get
You
Johnny and we're
tell.
gonna tell
Hey,
everyone about that history? You want me to go get cousin
come
John?
on, Bobby. Come on,
Yeah.
Bobby.
Yeah. Yeah. All right. All right. That 5-year dividend growth rate is 15.76%. They've increased that dividend for 16 plus years. They're less than a decade away from becoming a dividend aristocrat. Huge. Huge, huge, huge.
Yeah, and I firmly believe Kroger will become a dividend aristocrat. No ifs, ands, or but about that, guys.
Ooh.
Now, down 4% this year, down 11% since mid-November last year. That yield is now 2.72%. And that is actually about 60 basis points higher or 30% higher than that 5-year dividend yield average of 2.13%.
Beautiful. They're down 4% year to date and down 11.46 over the last year.
Good value. If you're looking for value, and as we've seen, such as yesterday's video, Target climbing back up, a bunch of other companies because of the CPI data and other, Fed being done with rate increases, yada yada yada. Kroger could be offering some great value right now. But Bert,
Yeah.
we said there were two stocks, not just one. This is not about one stock. So guys, let us know first. Do you own Kroger stock? And have you been buying Kroger stock? Let us know below.
Yeah. So let's head over to dividend stock number 2 today's video. We're going to talk about Cisco, ticker symbol CSCO. Whew,
Man,
man,
that
Cisco.
dividend dong song. Here it goes.
Yeah, well, that one must have
It
fallen
depends
off
on
the Billboard top charts here because Cisco just they took a beating from
yeah,
they took a beating from cousin Johnny Lanny. They
yeah.
didn't.
Cousin Johnny came, Big Nick, Little Nick took out his legs. They cut his Achilles. Because
Yeah.
what's interesting about Cisco is this. We're filming this, guys, on November 16th here. Stock price was down, let's just call it 10% today, 9.83%. Why were they down? It's got to be because of that terrible earnings release.
Uh,
Was it
Oh,
terrible? Was it terrible, Bert?
no, not at all.
What
Not
what,
at
what was
all.
it,
I
Cisco's
think
earnings release?
cousin Johnny might have picked the wrong house. He might have gotten the wrong person that he's supposed to shake down
You
here
got the
because
wrong guy.
yeah, I got the wrong guy. But they were revenue was 14.7 billion. It was up 8%. Oh, EPS, it must have been terrible at 89 cents. Awful. Only up 37%. Hmm. Did software subscription revenue go up? It sure did. It went up 13%. Guidance was only, maybe this was the thing, they're only expecting 53 billion to 55 billion of revenue, just small dollars here. I don't know. Yeah,
Yeah.
those numbers sounded terrible, didn't they, Lanny?
And the big headline, the strongest first quarter in Cisco's history, guys. So that sent the stock price going down 10%. Um, Balance sheet's also looking pretty good, guys. We like to look at the current, quick, and long-term debt. In this market, you got to stay nimble. You got to stay quick. Jack is right here watching us, guys.
Yeah, that's right. So let's see what happens. Let's see, run them through the screener and see. After this big tumble, their price was 48.04. Forward earnings were 371. That's a P/E ratio of 12.95x.
Yeah, solid PE ratio, guys. Undervalued against the total market. Undervalued against the other tech slash AI in the industry right now. I know that's big. Cisco's obviously going to indirectly benefit a lot from that. And by the way, their current ratio, quick ratio, long-term debt, all looking solid, improving. Long-term debt flat since the end of June.
That's
Um,
right. That's right.
Dividend $1.56 per share per year, spread over 4 quarters or 39 cents. A 42% perfect dividend payout ratio for Cisco. Again, ticker symbol CSCO. Perfect payout ratio, which means plenty of room to keep increasing that dividend, reinvesting into the business as well.
Beautiful. Absolutely beautiful. So let's talk about that reinvestment
Mm.
in the dividend. Its 5-year dividend growth rate is 3.92%, which, yeah, you're figuring
Yeah,
it all, Lanny. That's not the best for a tech stock. They've increased for 11 plus years, so they're almost halfway to becoming a dividend aristocrat. But the real story is your gut reaction, my gut reaction to talking about that 5-year dividend growth rate.
yeah. Last year's was just under 3%. And they've kind of gone on this 1 year tirade or 1 cent increase rampage, we'll call it.
Yeah, they're
So,
pulling a Walmart. They're pulling a
yeah,
Walmart.
they have the Walmart, the Emerson, the all the crappy dividend increases that we can label here on this channel, guys.
I guess it's
Cisco's kind of falling into that
I
habit.
guess it's better than the dividend cut bucket, right? Or the dividend cut class? That's some silver lining. That's some silver lining right there.
Now, Bert, with the stock going down 10%, what did that do to the dividend yield?
It shot it up, up to 3.25%. So well above 3%. Not bad for a tech company. Not freaking bad.
Not bad. Obviously you do want more higher dividend growth like Kroger, again, which was over 15% in the growth rate department. You do want a little bit more growth than 3.92 with a 3.25% dividend yield. That growth rate really stings right now when looking at them, but they're about flat this year, up 3% since last year. The yield is actually lower right now than it is on the 5-year average by about 70 basis points. So very
Yeah.
interesting there.
So let's put the chart up between Kroger, Cisco. What are your thoughts, Lanny?
Kroger's got great value. If you're looking for that long-term dividend growth stock that's going to pound that dividend, give yourself, 5, 7, 10 years to really see the yield on cost. Kroger is offering great value. Obviously not professional advice, but it's looking like a great stock to buy. More so than Cisco, only because PE is lower, payout ratio is lower, dividend growth is better. And hey, the yield will get there, and give it 1 or 2 years, and the yield on cost will be doing just fine.
Yeah, I agree. I think Kroger's the one that kind of jumps out between the two from the metrics, especially seeing that PE below 10. And their yield isn't even that far from 3% either. It's at 2.72%. Very solid with the metrics. Love the dividend growth rate. Love the years increasing. I think Kroger is definitely one that deserves to shoot up your watch list and be on the top part of consideration. Maybe they'll make it to a top stock pick on our Monday video, Lanny.
Yeah, maybe. That's a great point to make, guys. And if I were to put a price point for me personally, again, this is the best part of personal finance. I would look at probably both into the lower 40s. Kroger is theirs, but maybe just a little bit lower, to get closer to the $40 per share. Then Cisco pretty much needs to get closer to that 42 to 45 range before I start really getting, a little bit more into Cisco, more shares than I already have. But what do you guys think?
Yeah,
Do you guys?
You tell us.
Yeah.
We want to hear what your thoughts are about Kroger, Cisco, and if you're not watching these two companies, let us know what other stocks you're watching here instead.
Yeah, guys, let us know what stocks you're buying right now, what stocks you're buying heading also into December since we're, pretty much less than 2 weeks away. So keep us posted with what stocks you're buying or looking to buy right now.
Yeah, if you haven't already, subscribe to the channel. Give this video a good old-fashioned thumbs up, and Lanny, something else we got to do, isn't there?
Guys, if you're not with us, you are against us. Jack, that was Bert, the Hurt Locker, and Lanny from the Dividend Diplomats, over and out.